want to catch up on the Aussie dollar because it did a really good job last week of holding above 70 cents despite a hawkish Fed, higher US dollar, and not so hawkish RBA. Now, we've got quite a big data week for Aussie dollar traded because we've got from domestically, we've got inflation, household spending, and employment data. And from the US, we've got core PCE inflation as well. So there's quite a lot of data here over Wednesday and Thursday that could really move the needle for RBA expectations. But let's focus on the technicals for now. You've got this downtrend on the daily chart, which is arguably against a much bigger uptrend. Now, overall, as the year progresses, I do think we'll be looking at a higher Aussie dollar. Makes sense because they've got a higher interest rate compared to other major central banks. But for now, I do think we could be moving back down towards 69 cents, maybe over the coming few weeks. However, if we zoom in though, I just really like how it's held above 70 cents here. You've got a higher low relative to this bullish engulfing candle, and this is despite a stronger US dollar and hawkish Fed meeting last week. So that's a real testament to the Aussie dollar's strength. So I think the fact it didn't roll over last week is a good indication it could have at least a small bounce this week, possibly at least going into the big data sets I mentioned. Now, if you look at the US dollar, it's undeniably in a decent uptrend. It could maybe even come back up to 101.50 thereabouts. But you can see that the rally here lost momentum just above these highs. Friday gave this one bar bearish reversal candle. That doesn't mean we're looking for a massive reversal on the US dollar. It could just simply indicate a sideways movement that could bring some support for the Aussie. But also look how prices are extended above those moving averages. So we might get a bit of a pullback towards them. That could, of course, help the Aussie bounce over the near term. Now, if I look elsewhere for clues, the reason why I'm sticking to my 69 cents move eventually for the Aussie is because look at the yield differentials here. So this is the AU minus US 2-year differential. And that peaked a couple of weeks before the Aussie dollar did, and it's trended lower consistently since. And forex markets do have a tendency to follow their differentials over the longer term. It's not always perfect. It's not at the moment. Prices, of course, are holding above that 70 cents level. Decent level of support there. Technically, looks good for a bounce, but yields point lower further out. The other reason that I'm not overly bearish right now as well is if you look at this bottom chart here, we've got risk reversals, and in a nutshell, you would generally expect them to move in tandem alongside each other. If they're negative, it means there's more downside protection demand or put demand than call demand. And if it's increasingly negative, that means put demand or downside protection is outpacing call demand at a faster pace. Now, during this entire decline on the Aussie, risk reversals have remained negative, but not terribly so. They're not giving the exact same signal that we're seeing here on yields. So options traders aren't overly bearish yet is the basic take home here. So there is clearly price action signals saying that it doesn't want to go below 70 cents yet. There is the differential saying it wants to go lower eventually. Options traders are playing it cautiously. So there's a few things to work through here. And at the same time, of course, you've got near-term reversal thing on the dollar. So whichever way I look at it, I think a bit of a bounce here. What could change it from a small bounce to a big bounce is if we get perhaps unemployment falls down to maybe 4.4, 4.3%. We get elevated inflation still and household spending perks up. But I do want to show you the reason why I'm a little bit bearish on Aussie data at the moment is because of what we saw over the last month. So the top panel is headline inflation. It's elevated, but it did pull back ever so slightly. Then here we've got within the components of CPI, you've got housing. Yes, it's high. Yes, it's still rising, but at a slower pace. And we've got the same for transport. Now, transport and housing were key components of the drive behind high inflation in recent months. So the fact that they're tailing off are early signs that we're seeing inflationary pressures recede a little bit. We also know that energy prices are lower because Middle East isn't as bad as it was. So the case for the RBA's knee-jerk reaction hikes to Middle East is falling apart. Unemployment's at 4.5%. Participation rate peaked about 18 months ago. Full-time was negative, so was the overall employment figure. So it's relatively weak employment report for Australia, which has constantly delivered strength over the last few years. We also got PMIs either weak or negative. And household spending, I believe it was the minus 1.1%, which is its worst since I think it was October 2023. It's quite some way. So overall, put those together, the last month data was not great. And if we see any sort of repeat in that pattern, that's going to give further conviction from Aussie dollar traders that the RBA might be veering towards cuts, even though they won't signal it immediately. So do keep an eye on these key figures this week. As always, hope this is useful. Wish you best of luck with your trading.